Welcome to The Explainer. Today we're diving into something absolutely wild, one of the most fascinating intersections of modern finance, presidential power, and the law. We're looking at a real mystery, how single social media posts are literally driving explosive market swings, triggering billions of dollars in trades, and sparking an immense legal debate. Our goal today is simple. We're going to objectively follow the money to see exactly how these markets are triggered, who is actually profiting off those triggers, and what the complex legal reality surrounding it all really looks like.
Okay, let's jump right into this roadmap. First up, the market roller coaster. Then, triggering the markets. Number 3, the inside trades. And finally, is it legal?
Starting off with part 1, the market roller coaster. Let's look at the data behind the historic swings.
So, back in early 2025, we witnessed some incredibly intense market volatility, and it was driven pretty much entirely by sudden policy shifts. To really understand this, let's examine some Treasury Department data starting on April 3rd. The White House invoked the International Emergency Economic Powers Act to set up reciprocal tariffs. Right away, the Russell 2000 instantly dropped 6.6%, and the Mag 7 fell 6.7%. Billions of dollars were wiped out in a flash. But then, just 6 days later, on April 9th, a pause on those very same tariffs was announced. The Russell 2000 instantly shot up 8.7%, and the Mag 7 surged a massive 14.4%. Just like that, billions were instantly recovered.
Now, you might be thinking, what about everyday investors caught in that crossfire? Well, context is everything here. During those crashes, a huge Sell America panic actually emerged on Wall Street because of the tariff announcements. Yet, despite these really sharp, terrifying daily corrections and a brief bear market, the long-term indexes still saw massive overall growth. By April 2026, the S&P 500 had closed 19% higher than it was in January 2025. So the overall market went up, but man, those daily swings were an absolute roller coaster.
Moving right along to Section 2, triggering the markets, the anatomy of a trade. So how exactly does one single event trigger these massive market corrections? Let's walk through the crucial timeline for April 9th, 2025. This perfectly illustrates the anatomy of a modern market trigger. At 9:37 in the morning, President Trump made a post on Truth Social. Then, at 1:18 p.m., a 90-day pause on sweeping global tariffs was officially announced. And by the end of the day, the S&P 500 closed up 9.5%. That made it one of the largest single-day gains since World War II.
And what exactly was that 9:37 a.m. post? It literally just read, "This is a great time to buy, DJT." Impartially speaking, this public post acted like a massive financial trigger, and it was sent out almost 4 full hours before the market-altering tariff pause was officially announced to the rest of the world. The direct financial impact of that trigger was staggering. While the broader S&P 500 went up that 9.5% we talked about, Trump's own company stock, trading under the ticker symbol DJT, rose roughly twice as much, jumping nearly 19%. Estimates indicate this pumped the president's net worth by about $415 million in a single day. This exact sequence, a social media post, a massive stock buy-up, followed hours later by a market-moving policy announcement, this is precisely what has critics asking if this entire setup constitutes market manipulation.
Which brings us to part 3, the inside trades, following the money.
This naturally shifts our focus to the actual traders who are profiting off these perfectly timed swings. When the president's financial disclosures were eventually released, they showed that Trump himself bought 327 stocks, including tech giants like Apple and Nvidia, worth a cool $12.8 million. And the date of those purchases? April 8th, 2025, literally the very day before the massive tariff reversal and the subsequent market boom. But wait, expanding our investigation beyond traditional stocks to geopolitical prediction markets reveals even more, let's call it, lucky timing. On platforms like Polymarket, anonymous bettors were correctly predicting U.S. executive actions right before they happened. An account named Burdensome Mix won $436,000 betting on the exact timing of the Venezuelan president's capture. 9 anonymous accounts won 98% of their bets on the 2026 Iran war, netting $2.4 million. And back on traditional Wall Street, Axon Enterprise stock climbed 34% right after Trump bought shares and just before a major ICE contract was publicly announced. To really put this into perspective, you have to consider the objective scale of this trading volume. Disclosures from May 2026 revealed 3,642 individual trades made between January and March of that year alone.
That equates to roughly 60 trades every single day, with a staggering volume between $220 million and $750 million. The sheer magnitude of the administration's market activity is just vast. Naturally, this level of activity drew some intense fire. Former ethics advisor Richard Painter stated that if a defense secretary made these trades, he would be committing a crime, a fundamental breach of trust. In response to demands for investigations, President Trump publicly defended his family's investments. He argued that because the presidency is so powerful and big, any investment they make naturally conflicts with his policies, asserting there is nothing illegal about it. Which, of course, begs the ultimate question. Part 4. Is it legal? Let's look at the objective legal reality. All right, let's de-jargonize some securities law here and answer the looming question. Does this actually break the law? First, let's define insider trading based on the Stock Act of 2012. Insider trading occurs when individuals make stock trades using non-public information obtained through a relationship of trust. And importantly, the Stock Act expressly includes the president and executive branch employees under this restriction. Next, we have market manipulation. This is defined as creating a false or misleading appearance of active trading or artificially inflating a price, like your classic pump and dump scheme. And here's where we have to separate functional market triggers from the strict legal threshold. To be convicted of manipulation in the U.S., you have to prove false or misleading statements were made to artificially drive up a price. If a president posts that he's going to enact a policy and then actually enacts that policy, there is no lie. Even if it functionally swings the market at will, it doesn't cross that specific legal line. This reality becomes crystal clear when we compare U.S. and European law. Under U.S. SEC Rule 10b-5, you need proof of deception, lies, or untrue statements. Because the administration didn't lie about its forthcoming policies, they actually followed through on them. Prosecuting this under U.S. manipulation laws is incredibly difficult. However, the European Market Abuse Regulation, or MAR, broadly prohibits securing prices at artificial levels, regardless of intent. So while this behavior might easily violate European standards, U.S. law requires a much, much higher threshold of outright deception. And this right here is exactly how the presidential defense applies to insider trading in the U.S. Legal experts point out that because the April 9th buy post was made publicly to 9.4 million followers on Truth Social, it technically defeats the definition of misusing non-public information. Actually, if you think about it, because the president creates the policy himself, he isn't gaining information from an outside source. He is the source. Because of this, legal scholars widely agree that the federal case law here is fatally ambiguous. So this leaves us with a pretty massive question. When a single social media post can act as a digital trigger, swinging global markets by trillions of dollars and generating massive wealth for insiders, are our current laws really equipped for the modern presidency? Right now, we are watching a massive, real-time clash between 21st century digital market triggers and 20th century financial regulations. Thanks for joining me on this explainer, and we'll see you next time.